about today is, talk about diversification, what that is, and then really what diversification comes down to is asset allocation. So we'll talk about what that is and how important it is, because as we find out, that is by far the most important thing in every investment decision in the big picture is asset allocation. It's not picking an individual investment, but it's the allocation of assets. And then obviously when we do allocate our assets and our money to assets, we got to do it the right way. Had to be set to a specific goal. We'll talk about that a little bit as well. Okay, very basic. Diversification is as simple as don't put all your eggs in one basket. That's what diversification is in a nutshell. So you want to put together a portfolio of assets that are imperfectly correlated with each other. I'm going to give you an example in a minute. So if one of them moves up in value, you want the other one to at least not move up as much. There's got to be some sort of imperfect correlation. Ideally, actually, if you wanted to completely eliminate any risk, you would want that asset to move in the exact opposite direction, so that you have one asset moving up, the other one moving down, which then is just going to give you a flat return. That way you take out all the risk. Now that's extreme, but you can do that. There's two kinds of risk when we talk about diversification. There's a risk that we can actually diversify, and then there's risk that we cannot diversify. And I will illustrate that a little bit more in my next slide. So we have two. We have unsystematic and systematic risk. That's what we call those. Now, unsystematic or idiosyncratic or asset-specific risk, that is risk that you should be able to diversify. So let's look at something like, let's say you own stock in a company that makes umbrellas. So the company makes umbrellas, meaning you're going to make money, and the company's going to make money if it rains a lot. Now, a lot of rain, people need to buy a lot of umbrellas. So the company is going to make profits, cash flows go up, stock price is going to go up, everybody's happy. Now let's say the rain stops, and it doesn't rain anymore. Now all of a sudden nobody needs umbrellas anymore, and that's a problem. So the moment the amount of rain changes or shifts in the opposite direction, your company is not going to make money anymore, they might even lose money. Now let's say, well, I don't like that. I want to kind of eliminate that risk or diversify against it. Well, you can buy a company that makes sunglasses. So assuming that, if it doesn't rain, the sun is shining. So I'm going to buy a company that makes sunglasses. So every time the sun is shining, people are going to buy sunglasses. Every time it's raining, people are going to buy umbrellas. So if it's raining, my umbrella company is going to do very well, and if the sun is shining, my sunglasses company is going to do very well. Now I have effectively diversified away the risk of weather. Because regardless of what the weather is, one of my investments is going to do well. Without that, I would have always had to worry about, okay, is it raining? Is it going to be raining a lot this year? Because my return on my investment would be directly dependent upon the amount of rain. Now I don't have to worry about the rain anymore. That's asset-specific or idiosyncratic, or in financial theory we call it unsystematic risk. Now the other part is systematic risk or market risk. Look at the same two companies. So we have the two companies. We bought the company that makes the sunglasses. We bought the company that makes the umbrellas. Now let's say, again, people buy umbrellas when it rains and they buy sunglasses when the sun is shining, and all is good. Now let's say we run into a recession. So now the economy goes into a recession. There's less money to be spent, less discretionary income for the household. Now people are going to think about if they want to buy an umbrella or sunglasses, regardless of if it rains or not. Because they're thinking, yes, it's raining, but I really can't afford a new umbrella, so I'm going to take the old one, or I'm just going to get wet. I just can't afford to buy an umbrella right now. Or oh, the sun is shining, I just can't afford to buy sunglasses. So both companies are going to suffer because of an overall economic event. And there is nothing that I can do about that. As an investor, there's nothing that I can do and say, okay, what am I going to invest in to make that go away? I can't. I cannot do that. Every company in the market now, some are going to be affected more than others. Now, when we're looking at stocks, for example, there are companies that are doing very poorly in a recession, and then there are companies that are going to do okay, and then there are companies that are not at all affected by the economy. You know, it depends on what they do. One, company, we have consumer staples, for example. Everybody's going to still buy soap, and they're going to buy shampoo and toothpaste, regardless of the economy. But what about something that we call consumer discretionaries, like luxury retail companies? You know, if there's a recession, people are not going to go to Nordstrom anymore. They're going to go to Walmart to buy their clothes. And there's going to be an effect. And that effect is going to be seen. Nordstrom is going to lose all their customers, a whole bunch of them. And there's going to be a very strong effect, because that is a company that makes money from people that have a lot of discretionary income. If the discretionary income goes away because of economic factors, then that's what we see. Now, it's interesting, as a sidebar, given that the oil prices are so low, you would think that people have a lot more discretionary income, as they do, but we don't see it yet being spent. And it's very interesting, and I think, in my opinion, that is still an effect, a lingering effect of the financial crisis of 2008, because we have seen people put more money aside for savings. We have seen people borrowing less money. It's a very interesting fact, because prior to 2008, in 2005, for example, the US as a whole had a negative savings rate, as a whole, which means that on average, or as a whole, the US economy bought more than they earned. People in the economy bought more than they earned. So everybody, on average, bought on credit, which is amazing, which is not a surprise. What happened in 2008? But we don't see that anymore. So it's kind of an interesting fact that despite the fact that gasoline is so cheap, we have not seen that money actually go into the economy and really stimulate, because that's what everybody's waiting for, that extra money, that extra discretionary cash is going to have an impact. But we haven't seen that yet. Now, again, so we have this systematic risk or market risk. Again, that is risk that cannot be diversified, so we call it undiversifiable risk. And again, there is not much we can do. Now, we can alleviate it a little bit, and that is when we're diversifying, as what we are going to talk about most of it tonight, across asset classes. Now, I can diversify within an asset class. Like, I can buy stocks, and I can buy stocks from different companies. Or I can diversify across asset classes. So I'm not only going to buy stock for my portfolio, I'm also going to buy bonds, and I might buy some real estate or whatever other thing that I want to invest in. I might find all kinds of different asset classes. I might find an asset class, for example, that has no correlation with the stock market, which we generally label as alternative investments. When there's no correlation with the stock market, that's basically what you're looking for. And correlation is a statistical term and means it's the amount of co-movement. So something that is perfectly correlated is something that moves in the same direction. So if I have, for example, two stocks of companies that are perfectly correlated with each other, that means if one goes up 10%, the other one is going to go up 10% as well. But it also means that if the one goes down 10%, the other one is going to go down 10%, which means I have no diversification whatsoever. I am going to be all good or all bad. I have no mitigating effect if I have two assets in my portfolio that are perfectly correlated with each other. And that's generally very difficult, but what you will see is that stocks in the same industry are going to be obviously much more correlated with each other than stocks from companies across different industries. And again, the performance of Walmart, for example, is completely unrelated to the performance of Southern Company. You know, there's no relationship, no correlation between those two. Now, they both have and subject to market risk, so they're both going to be affected by a good or a bad economy. No? But if Walmart does good, has no bearing whatsoever on Southern Company and the other way around. There is no correlation between those two companies. Now, here's a little, you can see what I mean by this. So, no diversification, start upper left corner. Let's say you have these two assets, the blue one and the green one, in your portfolio. And as you can see, they move in the same direction every time. So they're perfectly correlated with each other. Meaning that your portfolio performance is going to be moving exactly the same way as those assets. So if there's a lot of change, a lot of volatility as we call it, your portfolio is going to see a lot of volatility. You're going to see a lot of ups and downs in your performance. And you know, that might not necessarily something that you like. So that's what happens when you have completely correlated assets. Now if you go to the bottom where it says some diversification, you see that these two assets are not moving, you know, at the same rate. Now they are kind of correlated in the way that when one goes up, the other one goes up, but there is some negative correlation in there too. And what that means, it smooths out the variability of returns in your portfolio. It makes your returns less variable. Again, it doesn't mean that you do not have downturns, and it doesn't mean you can't make money. There's a basic risk-reward relationship in finance or in investing. If you do not take any risk, you are not going to make any money. It is as simple as that. If you want to generate a positive return, you're going to have to take some risk. If you do not want to take any risk whatsoever, you can buy treasury securities. And you can buy a 10-year treasury note and you can get 2%. You know, you can do that and it's perfectly risk-free and you never have to worry about anything. But it's not really a good return on your investment. It's not going to take you anywhere. If you just take a basic, what we call the rule of 72, where you just divide 72 by the interest rate or the return that you can earn in an investment, and that tells you how long it takes you to double your money. So, you know, if you take 72 and divide it by 2, that's 36. So it would take you 36 years to double your money at a 2% return. That's a long time. You know, that, you know, at the same time, for example, if you can make 10%, it only takes you 7 years. So it's a big difference there. And you have to take some risk. There is no such thing, no such thing as a free lunch, and there isn't. You know, this is not free. You know, you have to come and listen to me. You know, that's, you know, you can't just walk in, take your food, and leave. I guess you could theoretically. You know, well, somebody would stop you at the door, I'm sure. But you know, there is no such thing as a free lunch. You know, and that's true in the markets too. You know, again, if you want to earn something, you're going to have to take some risk. Now, with these complete diversification, as you can see, those two curves move in the exact opposite direction. And as a result, there's no variability of returns. Now again, no variability does not mean that you are not going to make any money. Those are two very different things. It just means that it doesn't go up and down. You could average, for example, a 10% return on your portfolio. Now if you have that 10% return every year, then you have no variability in your returns. It's just going to be 10%. Every year after year after year, you make 10%. No variability. Or you could make, you know, 20% one year, and then you lose 10% the next year. Guess what? That's a 10% return too. But you know, you're going to be all happy when you make the 20. You're not so happy anymore when you lose the 10. And that's, you know, I just talked to some portfolio managers the other day. You know, how they pick their analysts and how they invest money for them. And you know, what they do is they pick investment managers. These are people that they're managing like $15 billion and they're picking different people to manage money for them. So then how do we pick them? Well, we don't need you. We're not so much worried about how much you outperform everybody. We are worried about how often you lose. Because the thing is, not one of our clients is ever going to contact us if you do well. But get what? If we lose money every other year, every time that happens, we're going to get a whole lot of phone calls. And it doesn't matter if it averages out to the same return over time. Every time it goes down, you're going to get a lot of phone calls. So what you need to do, you have to find someone who can steadily create a positive return without having to being wrong too many times. Because that's when even if you're on average doing very well, it doesn't help in the years when they're not doing well. And that's where diversification comes in. It gives you peace of mind. And some of that peace of mind comes at the expense of return. It does. I mean, that's just the reality of it. That again, I do have to take risk in order to make money. So let's look at, when we do diversify our portfolio, we have to allocate our money into different assets. That's what asset allocation is. So we're looking at how do I reduce my risk? How am I going to find, what am I going to do? What are the different things that I'm looking at? And it depends on, what exactly you want to do. But you pick some sort of investment portfolio. It should be based on what your objectives are. Different asset classes, and later on I'll give you a little pyramid of investment risk. Different assets, different asset classes have different risks. So depending on how many risks you want to take, that's how you load up or how you allocate your money into these different asset classes. If you want to take a lot of risk, you're going to take a lot of your money, put it in the high risk assets. If you don't want to take a lot of risk, you're going to put it in the low risk classes. It depends also on your risk tolerance and on your financial goals and how much time you have. When I'm 20 years old, I can take a lot more risk than when I'm 65. Because I don't necessarily need that money right now. I can wait for it to come back. I don't have to sweat it. But if I'm 65 or if I'm 70 and I have to rely on that income, I can't do that. I have to do it differently. Otherwise, I find myself losing a lot of money. And might have to go back to work or whatever else happened. There's a lot of things that happened to people in 2008 and might have wanted to retire at the end of the year, couldn't. I actually talked to quite a few people to whom that happened. And they just had to go on because they got, they lost 20, 30, 40% of their retirement portfolio in 2008. Now by now all of that would have come back and then some. But that didn't do anything for you in 2008 if you wanted to retire at the end of the year. So you want to lower your investment risk by, again, reducing portfolio volatility. That's what I said before. That line, that squiggly line, you want to make that as flat as you possibly can. That's portfolio volatility. The less it goes up and down, the better you sleep at night. It is as simple as that. The better you sleep. If it goes up and down, again, the average return might be exactly the same. It might be exactly the same. There's a whole lot of different ways to get to the same result. Very different, a lot of ways to skin a cat. But if it goes like this, you're gonna have a few ulcers at the end of this process. If it goes nice and smoothly, you're going to be a lot happier. And and if you give your money to somebody, if you have your money in a pension fund or something, you like those people a lot better. And manage your money in a way that it gradually grows rather than up and down and up and down. Generally speaking, there are some people that like the up and down, but generally speaking, you prefer to be smoothly. And then what you have is one investment's gain might be offset by a loss in another, or the loss in one investment is going to be offset by a gain in something else. And that's how you smooth out the variability. This is the determinants of portfolio performance. It's a source. And this is, there was a study done, this is in 1991 Financial Analyst Journal, which is the publication of the CFA Society, Chartered Financial Analyst Society. And they did a study, okay, what determines portfolio performance? And as you can see, it is asset allocation made up 91.5% of all the performance was determined by the asset allocation, not by which individual security I picked. Not, and certainly not by market timing. This is one of the biggest myth in the world that say, I got to time it right. That is the secret. If I'm just right when it goes up or right when it goes down, that contributes 1.8% of total portfolio performance is through market timing. Because market timing generally doesn't work, because we're generally we're normally too late. We invest too late, we sell too early. And not just individuals, individual investors, institutional investors do the same thing. We don't know. We do not know when it's all going to turn. We just don't. Some people have a better idea than others, but generally speaking, we just don't. Do we know that something's going to happen? Yes. You can look at indicators, and you know that the market, that something's going to happen. When you see PE ratios in the market, you know there's going to be a correction in the market. It's inevitable. You just have to look at historical averages. And there's a reason why we're looking at historical averages. Because if you look at something that's been true over 50 years, if you're now moving, let's say the average PE ratio, that's about 18 or 20 on the standard S&P 500. If it's 32, you know it's going to come back. Because on average, it has never been that high, and it's not going to stay that high. There will be a correction in the market. It's inevitable. The problem is we don't know when it's going to happen. We don't. And it doesn't matter. It does not matter, because if you just wait it out, and that's one thing. People that try to time the market, they're buy and sell all the time. Oh, I need to get out, I need to get back in, I need to get out, I need to get back in. And a lot of studies have shown that people consistently miss the exit and entry points. And they would have been much better off just staying put. Just do a basic buy and hold, you're generally better off than trying to find those peaks and valleys. So now I have to get in, now I have to get out, and then wait and go back in. It generally does not work. On average, it definitely does not work. Now again, it works for some, select individuals, that are very good at it, but on average, it doesn't work. It doesn't work for the average investor. Asset allocation is the key. Where do I put my money? Not as an individual. It's not about, am I going to put it in Coca-Cola or Pepsi? It's about which asset class. Where is it going to go into stock? And when I'm going to a stock, where does it go? Does it go in this sector? Does it go in energy or healthcare or consumer discretionary or industrials? That's where you have to make the decision. Picking the individual stock is really not something that anyone wants to do. You can just pick an index. You can just, these days, you can buy every sector. You can buy what's called an ETF, an exchange-traded fund, which is just a mutual fund, just a different word for mutual fund. And they replicate entire industries, entire sectors of the market. So you don't have to pick an individual stock. You just, do something that we call a core approach. You buy the core, which means you buy the index, you buy the entire sector. You think that this particular sector is going to, that one is good, this one is bad when there's a recession, this one is going to be fairly stable. Some have more long-term possibilities than others. And, that's how you can allocate, based on what you think or based on what somebody else thinks. In the stocks. You can reallocate within bonds. There are different kind of bonds. They're not all the same. And they're in different sectors too, or in different industries. That makes a difference too. So asset allocation is incredibly important. Again, it's not just this one study, it's a lot of studies that have shown that. But as I mentioned, the different asset classes, not Coke versus Pepsi, not should I buy Southern Company or should I buy another utility. Individual securities, picking the right stock, it's a very difficult thing to do. There's a lot of work that needs to go into this. There's a lot of analysis that needs to go into this if you want to do it right. Otherwise, you're just guessing. Now, you might think that you're not guessing. You might think that because generally, as human beings, we always believe if we picked the right stock, we did it because we knew, and if we picked the wrong one, it just got unlucky. That's generally how that works. But the truth is, we don't ever know. Because I can roll a die 10 times, and I can roll it 10 times in a row. Does that mean I know how to roll a die? Or am I just lucky? I don't know. You would think the more often I do it, there's some skill to it. Or maybe, the die is fixed. But at the end, it's very difficult. That's why you always have to look at long-term performance records. If you look at mutual funds, if you're looking at any kind of investment managers or portfolio manager performance, it can't be just, last year, or the last 2 years, or the last 3 years. They could just get lucky. It happens. You could just get lucky. Yes, you can get lucky 3 years in a row. Now, you're not going to be lucky 25 years. That's not going to happen. Warren Buffett is not lucky. Now, he knows what he's doing. But he has a long track record. Now, there are other people in the market, they know what they're doing. They're not lucky. But that does not mean they don't have luck here and there, and they just fall into something that just happens to work out for them, or they invest in something that doesn't. That nobody is immune to that. But you got to make sure that you know what you're doing, because you can't just go and say, well, I like this company because I saw a commercial and I thought the commercial was great. That seems to be a good investment. No, that's probably not a good reason why you should buy. Or I like their logo, I know somebody who really likes to buy their product. That's not enough yet. That's not enough. Because I can have a very popular brand that everybody buys and the company could still go bankrupt. It has been shown many, many times, particularly when you're looking at, back, for example, the internet craze. There were all these companies that were growing like crazy. Their revenues were going up and up and up. The problem is they could not do anything cost efficiently. So their cost went up just as much. Yeah, they would grow by 15, 20, 30, 40%, they would grow their sales. And they still wouldn't make a dime. Because their business in itself was not viable. And I had not a business idea or business strategy that was in itself viable. And there's some very, famous companies, now famous anyway, that almost failed because of that. Netflix is a great example. Netflix came about this close to failing when they first started. Because when they first started, most of you might remember, they were just mailing DVDs to people. And when they at the very beginning, they had to buy those DVDs. So they bought the DVDs, they had a huge warehouse full of DVDs, and they would ship them to people. Well, first of all, every time the US Postal Service increased the postage, that's a problem. Right there, that's a blow to your bottom line. Then they had to buy the DVDs. Every time a DVD got scratched or broke or whatever, they had to replace it. There was a time when they were actually selling these DVDs, so we could get those. And that model did not work at $7.99 a month. It started out at $15.99, and even that was too expensive. In order for them to break even based on that model, they would have had to charge you $49 a month, which nobody ever would have paid for that service. Because back then, you could still go to Blockbuster. And $49 would have still be enough to say, well, I just get in the car and go to Blockbuster, rather than waiting for the thing to come in the mail. So they needed to find something, to find a way to change that. And today, or that was before we could stream all this stuff. So they cut a deal with the studios. And they got the DVDs directly from the distributors for a cut of the profits. And that's how they were able to make it work. But they had to get there first. And without that, they would have shut down because their business plan or their business model did not work. Now today, it's a totally different story. Obviously, Netflix has come a long way, and streaming certainly helped with that. But they were very close because the business model in itself didn't work. It didn't mean that they weren't growing and were incredibly popular, but they're still almost folded. And that happens to a lot of companies. So just because they look good, or there seem to be a lot of people buying something, that in itself does not make a company viable or profitable. There's a whole lot of other factors to that. So it's sometimes easier to just go with, I want to buy, I want to diversify between asset classes, and with inequities, I want to buy certain sectors, just buy the whole thing. Just buy the whole sector. Buy a mutual fund and an ETF that represents that entire sector. Now, let's look at this as an example. Two scenarios. You invest $100,000 at 8% over 25 years. So it's 8% a year. That turns out to be $684,848 if you do that. This is a steady return of 8%. Now, at the same time, you can do the same $100,000 and you invest them equally, meaning 20% of your money or $20,000 in these 5 investments. One investment is you're going to lose your $20,000, meaning you have no money left, $20,000 are completely gone. One is not going to earn anything, so you just have $20,000 after 25 years, $20,000 after 5 years, 25 years, and the other ones are going to earn 5, 10, and 15% respectively over the next 25 years. You end up with $962,800 in that same portfolio. In that same portfolio. Now, if you actually were to calculate the average return on this, it would be, because losing the interest is a negative 100%. You would actually come up with a negative average return on your investment. That would make for a negative average. But obviously, you get $962,800, and the reason why you do that is because particularly 15 and your 10% return are going to way make up for the money that you lose. If you can make 15% every year over 25 years, that's a whole lot of money. And that is going to, over 25 years, compound to so much more than 8%. It's less than, if you think about it in terms of, 15% is less than twice of 8%. But it's going to return a lot more than that. If you were to take $100,000 invested at 15% over 25 years, you would have more than twice of the $684,848 in total return because of the power of compounding. So that's why, so if you spread it out, the high return investments are going to really make money for you. But you gotta, that is the good one. Some others might fail, but by spreading it out, by having your money invested in 5 different asset classes, you actually end up making more money than if you had just put it in one thing and had created a steady return. That is the power of asset allocation, and of diversification across different assets. Now, the factors that you need to consider, obviously, is your investment horizon, which investment objective rather. Is it retirement? Is it for a major purchase? Why are you investing? Why are you putting this portfolio together? What do you want to do? What is the time horizon for the goal? So, for example, if my goal is retirement, okay, I know when I want to retire, but now I'm going to have to think about for how long am I going to be retired? You know, it's not just, okay, I want to have this amount of money when I'm retiring. Is that actually going to be enough to take me through the next 30 years? Because that's, you know, obviously one of the challenges that we have, that, you know, thankfully everybody's getting older. You know, life, you know, when Social Security was enacted, you know, you could get it at 65. Average life expectancy in the US was 63. You know, on average, nobody ever got Social Security. That's why it worked so well. You know, it doesn't work that well anymore because, you know, it's still the same system, but, you know, the life expectancy is now almost 80 years old, and, you know, people are retired for a long time. Thank God that it's that way. But you got to have a little bit more money to make it actually, you know, the longer you live, the more money you're going to have. So you're going to have some idea that, okay, this is because you're going to save that money up to retirement. Generally after that, you're not putting any more money to it, but you're just pulling from it. So you got to make sure that when you get to that point, you have enough so that you can comfortably withdraw from that for the next 25 or 30 years. So that's part of it too, when you're figuring out what you need to do. And, you know, and also for the goal, time around, okay, I want to do this for 30 years, I can't afford to lose any of my principal. Now, so my asset allocation completely shifts. When I'm to the point where I'm not adding to it anymore, I'm just withdrawing, I can't afford to lose principal. I can't afford for the value of my portfolio to drop by 30%. Because all of a sudden, I might not have enough to make it all the way. You know, and that's a problem. That's a scary thing to happen. And again, in the bigger scale, that's exactly the problem we face with Social Security or state pension plans. That, you know, yes, there's a whole lot of money in there, you know, but are we going to have enough to carry everything through? And at this point, we don't. It's as simple as that, we do not. We don't have in Social Security, or for example, the Alabama retirement system, the state retirement system, they don't have enough money in there. It's well underfunded. It's at like 65% or something. It's the funding level of that retirement system. You know, so meaning it's 35% underfunded. You know, that's a problem. Got to find a way to fix that. Or a great example for, you know, investment objectives completely gone wrong is the prepaid tuition plan that the state of Alabama had that completely blew up in 2008. You know, this was a portfolio that was designed, you know, you put the money in, and then when your child goes to college, the tuition is already prepaid, so the tuition money comes out of that fund. It's a fixed cost. You know you're going to have to make those benefits. You're going to have to make those payments. You cannot afford to invest. You have a portfolio that's 85 or 90% invested in stock. But that's exactly what happened. That's exactly what they did. That portfolio was heavily invested in stock. So when the stock market tanked in 2008, well, that was it. Now, all of a sudden, they couldn't make the tuition payments anymore because all the money was gone. Because there was a ridiculous investment policy that they were following for that kind of portfolio, for that kind of objective, investment objective that they had. It wasn't really bad. They just figured, you know, if it goes bad, the taxpayers of Alabama are going to bail us out. What they forgot to mention is that a few years prior, unbeknownst, by the way, to the people that paid in there, the state of Alabama had changed the laws and said, no, we're not actually funding that anymore. So if you go out, so we're not putting taxpayer money in there to make sure that you get your money. That's exactly what happens. They have to come up with some rescue plan and shut the whole thing down. You can't pay that anymore. You know, that prepaid tuition program is gone. Now, if you were in there, it's still going to pay you, but it doesn't take any more people. It's discontinued.
And that's a lot of graduates that graduated between 08 and 12, even now, are finding themselves deep in student debt because their parents from this scenario are no longer able to pay for their child's education. And you, like you said, you got a lot of people living at home, 20s and 30s. because of this very scenario.
Yeah, and that was bad investment policy. That's all it was. It was just bad asset allocation for that particular investment objective. It was a very specific investment objective, paying for the tuition payments. It's a forecastable cash flow. You know exactly how many people are in the, you know exactly when they're going to go to college. You can forecast these cash flows with almost 100% certainty, except for tuition hikes. And they did not invest accordingly for this particular scenario. So that's why it is very important to have an investment strategy or asset allocation that goes hand in hand with your objective and with your time horizon. Because if it's not, then it's a problem. And you find yourself, or you could find yourself in some trouble. Amount of money you have to invest, of course. It's a, certain investment opportunities might not be available to you because you don't have enough money to contribute. Now the good thing is, these days, almost everything is available through mutual funds, which means everything is available to everybody. There was a time when there, for example, were no bond funds. In order to buy a bond, if a bond has a face value of $1,000, one bond going to cost you somewhere between $800 and $900. Not everybody might want to invest that. You might have that. You might have $500. Well, what am I going to do with the $500? Well, the only investment that was really available to you, where you could buy them, was stocks, because they had low, or some of them anyway, low enough prices so that you felt good about it. Because there's something psychological about this too. If you have, if you have $1,000 to invest, and say you buy $1,000 worth of stock, you feel so much better if you buy 100 shares at $10 than if you buy one share at $1,000. Even though it makes no difference. It makes no difference in your portfolio if you have 100 shares of that same company at $10 a share, or one share of that company at $1,000 a share. Makes no difference whatsoever. But psychologically, makes a huge difference. There's tons of studies done in behavioral finance on that. That's why companies split their stock. Because when the stock price goes too high, investors are going to shy away, particularly individual investors. And they want to get their stock price back up. They want to get liquidity in the stock, the trading volume of the stock back up. So they split the stock. And the exchanges are going to encourage that, because that's how the exchange makes money. The more often the stock trades, the more money the exchange makes. That's why they don't like Berkshire Hathaway. That's why the New York Stock Exchange does not like Berkshire Hathaway. That's Warren Buffett's company. Because one share of that company is $1 million. Because there are not that many shares outstanding. They trade like 20 of them a day. Now the New York Stock Exchange doesn't make any money over that. They don't like it. They've been present, split your stock. But Warren Buffett doesn't want it because he doesn't want to have that many shareholders. I said, no, I'd rather have a small group of people that come to Omaha every year, this is speak, and I don't want all this turnover in my company. I'm not splitting my stock. But most companies, that's what we call a popular trading range. It's somewhere between $15 and $50. It's moved up a little bit. It used to be that any stock, when it reached like $75, $80, you would see it split very quickly. You don't see it as much. Some of the companies, you look at companies like Google or something, they haven't, they're way up there. They haven't split yet. Most valuable company in the world now. They surpassed Apple the other day. Google is now the world's most valuable company. But some things you just can't invest or buy, or before they were not available to you because you didn't know how to get them. Like, I will buy a municipal bond. How am I buying a municipal bond? It's not that you can just walk into somewhere and say, well, I want to buy a municipal bond. It's very difficult to do so. But now you can buy mutual funds that invest in municipal securities, and there is your opportunity to get that particular asset class. So it's gotten a lot better. It's really that we invest in anything. You can say, and again, I'll show you that triangle in a minute, but you say, okay, I want to invest in gold. Now, 20 years ago, you would have actually had to go and buy gold, like physically buy gold, which is a problem because it's a commodity. And as a commodity, it comes with sales tax. So if you buy gold, you're paying 10% sales tax, which means you're going to have to earn 10% just to break even. Because you're 10% in the hole the moment you buy an ounce of gold because of the sales tax. Now I can buy an ETF. I can actually buy stock or buy a mutual fund where the value of that fund is based on the value of gold. Now I don't have to worry about sales tax anymore. I can still benefit from that. I can benefit from changes in commodity prices. Maybe I wanted to invest in, oil. Not a good idea right now, but let's just say I want to invest in oil. I couldn't do that. I wasn't able to do this, 10 years, 15, 20 years ago. I could have said, I really want to invest in oil. How am I going to do that? And now I can do that. I can go out and I can buy a fund that invests in oil, and I can be a part of that. And I might just have to $100. I can put those $100 in there. I want to invest in currencies. I can find a fund that invests in currencies. I can put my $100 there. I have opportunities today in terms of asset allocation that were not available 20 years ago to the individual investor. So it's gotten a lot better. You have all these different funds and all these different things that they do. Your risk tolerance and your experience. There is if you don't understand what it is that you buy, you probably shouldn't buy it. If you're new to this, you have to be careful. Don't let yourself talk into something. And anyone who ever gives you a hot tip, you always got to wonder why they do that. If it is such a valuable advice, why are they giving it to you for free? Why are they not just doing it? And yeah, it's a very cynical way of looking at things, but if you are, depending on who you are like in terms of your money, if you get a call from your broker and you have, let's say, I don't know, total value of your portfolio of about $50,000, and they're pitching some hot new stock to you, I guarantee you that that stock is not so hot and not so new. Because if it was hot and new, they would pitch it to the people with a $500,000 and $1 million and a $5 million portfolio first. Because those are the clients that they want to keep happy. Now, once they come all the way down to you, that means all the other ones didn't want it. And there's generally a reason why. It's particularly when it comes to initial public offerings. When they're pushing these and they're coming to you as a small investor, you know it's not that hot a new offering. Because the hot ones, they're going to be taken up by the people with a high net worth. They're the first ones that get being offered those. That's how it works for you. Why? Because that's how the brokers make money. They work off commission, and you want to keep the high net worth people happy because that's where you make your money. It's as simple as that. Can't fault them to it. That's just the way the system is set up. But that's what happens. That's what happens. So your experience and again, risk tolerance. How much risk am I willing to take? If I cannot handle any risk, and maybe I should just invest or allocate most of my money into something low risk, very low risk, very low key. If I'm a little bit more adventurous, then I might be willing to invest in something that other people would shy away from. Your age and the net worth. Again, the more money you have, the more risk you can take. And at the same time, the older you are, the less risk you should take. Again, if you're 65, you should not invest your money in something high risk. That's not a good idea. If you're 25, of course you can do that, because you have plenty of time to recuperate. If something goes wrong. So it makes a big difference. Again, you might diversify your portfolio, and then you kind of talk to your neighbor or friend and say, "Oh, I invested in this stock, and I made all that return." And you say, "Well, you loser." And I remember a lot of this happening during the internet craze in the late 90s, early 2000s, where people would go, "Oh, you got to invest in all these stocks. This is going to be the next coming, and it's going to make so much money." And everybody was throwing money in there, and everybody who was saying, "Well, I don't know, and I'm not so sure about this." They were all looked at. There was a time when everybody started doubting, for example, Warren Buffett, because he never invested in any of these. He said, "I don't know what they're doing." You know, I don't understand their business. There are no assets. I don't know why I would invest there. And everybody said, well, I guess he's lost it now, and he doesn't know what's going on. And, you know, 2 years later, everybody invested in those tech stocks, lost all their money, you know, and he said, well, see, I told you, you know. And because, you know, it was just, but at the time, it was, oh, everybody was questioning, no, you should do this, you should do this. You're going to look, you know, look at my return relative to your return. I'm doing so much better. Now, one of the things is, and that's why when we looking at returns, generally we want to look at them at a risk-adjusted basis. You know, if I generate 30% return, and somebody else generates 10% return, if I take 3 times as much risk to get to those 30 than the person who gets 10, I'm not doing really any better than that person. Because I'm just being compensated for that risk that I'm taking. Now, if and that's how it would go to the casino and play roulette. You put your money on red or black, there's a 50-50 chance that you're going to win. So your payout is exactly that. You double your money. If you put your money on just one individual number, well, there's a 1 in 33 chance that you're going to, how many numbers are there? 1 in 36 or 37 chance that you're going to include the 0, that you're going to win. Well, and your payout is going to reflect that too. Well, and you know, so if you're looking at the return on the investment, the person who put the money on the number and wins says, well, see, told you, I'm much better than you. No, you are supposed to win that much because you have a much bigger chance of losing it all too. You know, it's as simple as that. Now, does that person feel good about themselves? Of course they do. Just like the people that won, you know, the Powerball a couple of weeks ago. You know, and should they feel very good about the $500 million or how many they're won per person? And as I see, I told you so. But, you know, at the same time, how many million people played this Powerball and did not win? You know, because the risk of not winning is so much higher than the chance of winning. At the same time, you can't win if you don't play. You know, that's it. That's the other part of it. You can't win if you don't play, but you have the risk tolerance to do it. You got to be okay with the fact that you might lose it all. You can't say, and you can't buy $1,000 worth of lottery tickets to win the Powerball and not win, and then whine about it and say, oh, this is just not fair. No, your statistical chance of winning is so incredibly small, you should expect not to win. You know, you should expect, nobody who ever plays the lottery should ever expect to win. Because if you were to expect to win and everybody would win, there wouldn't be a lottery. It's the same if you go to the casino. The casino stays open because you lose, not because you win. And so you got to lose more than you win or the casino is going to shut down. You know, that's why, you know, that's how these things work. You got to expect to lose. So if you invest in something that's really high risk, you got to expect to lose. And you got to be okay with it. If you're not okay with it, you shouldn't be doing it. No? And then again, what it does is you create volatility in your portfolio. Oh, I put all this in. Today, the return or the price of my investment went up 100%. And then tomorrow it goes down 50. And then the day after it goes up 10. The day after that it goes down 15. You know, again, at the end, after 10 years, you might have averaged 10%. That was a heck of a ride to get there. You know, and if that's what you're into, if that's really what you want, that's fine. But generally, as it's, I think you don't know what the hot asset class is in advance. Generally, by the time it's hot, it's already overpriced. You know, so you come there too late, and you're not going to be able to benefit from it. And again, you want to reduce the volatility. That's what you're trying to do. That's the whole point of diversification. You want to reduce volatility. So if I don't want to diversify, yes, I can look for the one big thing that I think is going to make all that money, or just get rich schemes, and I put all my money in there, and I see what happens. Then obviously you're not interested in diversification, you're not interested in reducing your risk or your volatility.
Is this price when it was first on the scene, but it came to an actual more stable price later on.
Well, with Facebook, first there was all kinds of issues when it was issued, technical issues, and I couldn't get all the orders filled and all of that. It was a total disaster for the exchange. It was really a blackout for NASDAQ for that matter. But it was a stock that was very hyped up, and then people sat back and said, "Ooh, wait a second. Yes, they have all this potential, but are they going to be able to monetize that potential?" That's all it comes down to. Are they able to monetize it? And eventually they were actually able to do that, and that's why the stock went back up. But first was Facebook, this all new, it's great, has enormous reach. I can reach millions of people in an instant. The marketing potential is enormous. The advertising potential. I can sell advertising space on Facebook for very little money if I want to, or I can reach, if you advertise on Facebook, you can reach millions of people. And these companies, they know everything about you. They know everything about you. If you ever noticed, you go, let's say, on Amazon, and you're looking at some products, and then if you have a Facebook page, you open up your Facebook page, guess what's going to pop up on your Facebook page? That exact same product. And it's going to be pushed to you over and over and over again. That's how they make money, because they know everything about you. And and they're able now to monetize on that. Like Twitter, for example, they have found a way to monetize on their success. That's why their stock is like in the free fall. Because nobody knows exactly, okay, how are we going to make money with that? Facebook has figured it out. And Instagram really helped too by doing it. But so that's where the money went, the stock price went by. Initially, it was all hyped up because all Facebook had looked, and then people sat back and said, oh, how are they actually going to make the money? And then they saw how they're going to make the money, and that's brought it back up. But yeah, there was a whole lot of hype too, and there was a lot of was written up in the papers and all of that, and everybody talked about Facebook IPO and this and that, and Facebook talked about it, of course, that creates a lot of hype. And you have a lot of individual investors, and I want to get some Facebook stock, I want to get some Facebook stock. So you got all these orders coming in, and the underwriters, oh, look at that. There's enormous supply, enormous demand for that. Let's just increase the initial price a little bit, because we can. And that's effectively what happened. And that's how how Mark Zuckerberg became a billionaire overnight. Yes, Martha.
Hi, I'm reading a book by Donald Trump and another man that talking about how to get rich, and they talk about the way that most people teach it, like diversification, and also I just took a seminar with Dave Ramsey's daughter, and she teaches the same thing about the diversification, but he was more like, people don't have much, Donald Trump and this other man, they say that most people don't know very much financially, don't have much financial education, and they say that the real way to make wealth is like they study all they can and master a certain technique, and then decide if they like it or not, and move to another one. And do you think that people are not really being educated enough? Like even the ones that are trying to make smart decisions financially, do you think we really understand the money system and really how it works, and do you think we're really studying the right things?
Well, we wouldn't be doing what we're doing right here without people who are all educated about that. So, and FINRA would not have an investor education program. No, we're not educated about it. There's a whole lot of people that are not educated about it, and they get their advice from secondary sources, and they don't know if that is a good or bad advice. And that's how they find themselves losing money or being effectively screwed out of their money because they know what they're doing. And no, we're not educated enough, and that is a problem. Yes.
But even if you do your due diligence, Steve Jobs announces that he's dying, or Target has a data breach, and there's no way you can predict. Even if you do your due diligence, you can't predict that.
No, that's the risk that you take. You can never predict that. If you wanna, that's why if you want it to be risk-free. And obviously this is an unexpected thing. We don't know, and it's a bad thing, but that's a risk that you take when you invest in equities. If you don't want any risk, get a savings bond. You know, get a treasury security, get a CD. You know, you don't have any risk, but you're not going to get any return. But you're absolutely right, you're not going to be able to foresee certain things. It doesn't matter how much you invest.
But, you know, if you get a CD today, you're...
Well, yes, of course,
You know,
of course.
So
Yeah.
how can you, I mean, you might as well not buy one if you're only going to make, you know, 60 cents on $20,000. That's an exaggeration, I know, but
I
what's
agree.
the...
It's a problem. Yeah, no, it is a problem. As you know, somebody asked me a few years ago, and I said, you know, you can as well bury your money in the yard. You know, it doesn't make any difference. You know, the only thing is if you have some money, you know, buy a house. You know, because you know now the markets have gone up a little bit. There was a time when we had this incredible thing happening where we have we still have low mortgage rates and low real estate prices, which generally doesn't happen because it doesn't make any sense in the market sense that to have low mortgage rates and low real estate prices. Because low mortgage rates would actually, you know, stimulate demand, would increase real estate prices, and vice versa. But we had a situation where we had low rates and low prices. And if you had the credit to do that, there would have been no better investment than that at that time. Now, unfortunately, the banks were a little stingy with the mortgages, and you know, and they wouldn't give you the money. And obviously, if you wanted to refinance, it was a problem. But that would have been, if you had some extra money, that would have been a great way. And, you know, somebody who invested in the real estate market through certain vehicles at the time would have made some money. But you're absolutely right. The traditional, if you will, investment tools right now are not generating any money because the interest rates are so low. You know, and that's not going to change until interest rates go up. And that's why we've seen the stock market surge the way it has. It's not because the economy or these companies are doing all so well and they have recovered so quickly, but because you couldn't get any return in the bond market. So in order to get any return, you would go in the stock market. And I guarantee you, the moment interest rates go up, there's going to be a whole lot of money going out of the stock market back into the bond market. So we're going to see a big market correction. You know, we just don't know when it's going to happen. You know, because based on what, you know, now we're not going to see interest rates go up anymore for a while, you know, based on that latest economic news. So, but we just don't know, and that's the market timing aspect. You know, when I get in, when I get out, and I'm just better off just staying in where I am, and then when I don't miss anything. But that's, you're absolutely right, it is a problem. And, you know, in every asset class, it is a problem. If you look at all these different, you know, you have the stocks, obviously. There's all kinds of different stocks. And then there's bonds. And there's real estate. And again, you can invest in real estate through what's called a real estate investment trust. That's what REIT stands for. Which is just a real estate mutual fund. So you there invest in real estate. It might be residential, it might be commercial. So you make money in the real estate market. You don't actually have to buy an office building. You just buy, you know, a portion of that investment fund that owns the investment, that owns the office building, and when they make money, so do you. And they are very strictly regulated. They have to actually pay out dividends on a regular basis. They cannot reinvest all of their money. They are required by law to pay out dividends, and I think 90% of their income has to be paid out in dividends. So this is a way for you to invest in real estate. Again, cash assets always going to be the ones that are, that's cash as means like short-term, the short-term investments, always going to have the lowest return. That will always be the case because they don't have any risks. If I buy a CD up to $250,000, there is no risk to them. Even if the bank were to go belly up, I get my $250,000. It's FDIC insured. I get my money. I might not get the return that was promised, but I get my $250,000 back. That's a risk-free investment. If I buy treasury securities, I get my money. The treasury has only defaulted on their debt once in their history. They actually did in the 80s. There was a technical glitch, but they did actually default on treasury bills. They were due in April. They didn't pay it back until mid-May. Which was interesting because it increased the price of treasury bills by 60 basis points. permanently cost the government extra $1.5 billion in interest charges going forward. That's why I always say, everybody who discusses the debt limit and says we are not going to increase this and we're going to play with the treasuries should read that article. It's an academic study that looks at that particular one case when it happened, exactly what impact it had. Because that's exactly what would happen. Just not to just treasury bills, to all the debt. And then instead, then we would increase our interest payments by $10, $15 billion a year, because we have to pay higher interest on the debt. Yes?
Can you tell us again what that study is?
Oh goodness. It's oh my goodness. I have to look it up. I can email it to Katie and she can put it on the website if you're interested. It's in the Journal of Finance, I believe, in 1989 or something like that. But it's a highly technical paper. It's an academic paper. But it shows that incident increased borrowing costs by $1.5 billion and increased the interest rate by 60 basis points, which is 0.6% because of that. Because now the stigma of never default was gone. Defaulted. I can never go back to I never defaulted. I will never get that status back. I defaulted. Now we still consider treasury bills risk-free. That's our go-to risk-free investment, and everybody does. And every time we look at auctions, they are 3, 4, 5 times oversubscribed. So the treasury has no problem whatsoever to sell their debt. They do it every week. Every week they're issuing something. There's, the national debt is at 15 trillion, but only 11 trillion of that is actually, or 10 trillion is actually debt. The rest of the Social Security Trust Fund, the other 5 trillion. So that's something different. But because they invest, the Social Security money is invested in treasury securities, but we have to put this on the side. So those $10 trillion, they need to be refinanced on a regular basis. Not to mention, as long as you have a deficit, you need to raise more money to pay for that. So the Treasury is going to continue to issue securities. Now, here's this pyramid of investment risk that I mentioned. High versus low. Now, theoretically, we can invest in all of this. I would strongly discourage anyone from going into that red triangle. Particularly if you're not knowing what you don't know what you're doing. Now, options and futures, very specialized assets classes. You need to know what you're doing. There's a loss of total capital possible every time you do that. Total losses are possible in options and futures. Collectibles is an illiquid investment. Beanie Babies, baseball cards, memorabilia. What determines the value of memorabilia? Not what you find in the catalog. You can look up the catalog and say, oh, this 1938 Ruth baseball card is worth $1 million. No, it is worth whatever somebody's willing to give you for it when you're trying to sell it. That's what it's worth. And the more desperate you are, the less it's going to be worth. And you're going to have to first find someone who's actually interested in it. It's not a good market. It's not a liquid market. You have to go out and find someone. You go to somebody who sells collectibles. They're going to discount that value rather dramatically because they know. It's the pawn shop effect. If you go to the pawn shop, they're not going to give you the true value of what you're giving them because they know you're desperate. So they're going to give you what they think they can get away with. And that same is true in collectibles. They're going to give you what they think they can get away with. So it's not a good investment because it's incredibly illiquid. Now that doesn't mean, if you like baseball cards and you want to look at them, by all means. But don't ever tell me I buy baseball cards because it's a good investment. Because it's not. Just think about baseball. Just think of the poor guy who bought what's the guy's name? Sammy Sosa's baseball, and what's the other guy? Barry Bonds and Mark McGwire. The guy who bought Mark McGwire's baseball, I think, paid $1 million for it. That thing is not worth the value of the baseball anymore. You know, you might be able to sell it for $10, $15, $20, maybe. You know, now some people are weird. I mean, like, you know, when O.J. Simpson had to auction off his Heisman Trophy, somebody actually bought that. What are you going to do with somebody else's Heisman Trophy? Are you going to put it on a mantle and try to convince people it's yours? I mean, what do you do with that? Why would you pay? I don't know how much they paid for it. Something that clearly is not something you earned. You know, it's not like, okay, a plus or something. It's an award for performance that was clearly not yours. Why would you pay for that? I don't get that. But, you know, anyway, yes.
If you wanted to go slightly higher with higher risk, wouldn't that be speculative? Not futures, but something that's not even there. It may be there based upon some algorithm, computer program, or historical data. Or if you push it toward the future, you can say, well, I can see this happening, so you can invest in that. It may happen. Now, you know it's a high risk, but the thing is, it may never materialize. It's just a thought or an idea. There are some groups that are investing in ideas now, a high-risk speculative idea. So it sounds great. So 30 years from now, it can be patented, and then therefore I can get, you know, is that higher than the future?
Well, no, what? You know, I mean, the futures, it says out there because, you know, you can lose all your money, but if you invest in an idea, you can lose all your money. You know, I mean, it's not a complete list. I could say, I invest in drilling rights. You know, so I'm buying drilling rights to drill for oil somewhere, and guess what? I'm not finding any. You know, and there goes my investment. And you can do that. There are companies, no, you don't get those at US stock exchanges, but you can go to the Vancouver Stock Exchange and you can buy stock in companies that are drilling for oil somewhere, you know, and if they find oil, you're going to make quite a bit of money, or gold, or whatever they're looking for. And if they don't find any, the company's going to fold and you're out of luck. And you're not going to get any money. That's a high-risk investment. So there are other kinds of investment. People invest in movies, they invest in, you know, in television shows. I mean, all of these things, these rights are investment. You know, somebody buys the rights to a music catalog, you know, that's an investment, you know, and when you know, Napster came along and everybody got their music for free, that was a good thing for the people that invested in those catalogs, you know, but there's things out there that we don't even think about that people invest in. And there are people out there who are selling these things. And there's huge industries for all of those, and there are markets for all of these, and people that buy those. It's just that if you do invest in things like that, you got to be aware of the fact that you might lose all your money, and you better have some idea of it. You know, again, another thing, you know, something Warren Buffett said, that he never invested in any company whose business he does not understand. You don't understand what they do? How do you know that they're going to be successful? The only way that you know is because somebody else is telling you. When they're telling you the truth, there's no way for you to check it because you do not know. You just don't know. Now the middle, that's the real estate, the mutual funds. That's where, you know, that's where we are when we have time. You know, when we can afford volatility. These are going to be more volatile, there's going to be more risk, there's going to be more return. And then on the bottom, you got all the things that are not going to generate a lot of return, don't have a lot of risk. Now what you can do, and actually what you should do in your portfolio, these are your assets to allocate. How much do you want to allocate in middle risk assets? How many do you want to allocate in low risk assets? That way you diversify. Every time you put a low risk asset into your portfolio, you're going to lower the volatility of your portfolio because it's going to cushion the blow of anything high risk that you have. If you put everything in high risk, there's nothing to cushion the blow. If you have something that performs steadily, you always have something that's going to cushion the blow if there is a blow. And that's why you want to do that. And again, I already talked about that. One other things that you want to do, you're going to at some point have to pick a specific investment, and you're going to have to rebalance your portfolio. And that's the last slide. The portfolio risk decreases as the number of asset classes increases. We call that naive diversification. It's the naive diversification. I don't really have a plan. So as I said at the very beginning, we want to pick assets that are not correlated with each other. But I could run all kinds of statistical analyses and find those, or I can just throw a bunch of them into my portfolio, and I get a diversification effect as well. And we call that naive diversification. You can do that in your equity portfolio. And we can show it statistically that if you invest in 20 different stocks, 25 is about the maximum. After that, you don't get much of a diversification effect anymore. But you could randomly pick 25 stocks and you have a pretty well-diversified portfolio. As far as concerned. Now, not 25 on the same sector, but 25, take the Wall Street Journal, take a dart and just throw it at the Wall Street Journal and see which companies you get and those you invest in. You do with 20 of them, 25, you have a pretty diversified portfolio. It's called naive diversification. Just by the pure number of assets in there, you're going to get that. Because they're not all going to be perfectly correlated with each other. It's impossible for that to happen. So you will have a diversification effect. Just by doing that. The best results are achieved over time. Patience is always true. You look at it, again, that's the thing about diversification. You don't get a big return. You don't get, oh, I made 25%. But you also don't get the big loss. Over time, it's a steady increase in the value of your portfolio, and it's going to get you there. You're going to get there the same way as and being better than the high volatile portfolio. And again, you're going to sleep much better at night when you do that too. You diversify your holdings within each asset category. So not just across the assets, or buy some bonds, or buy some stocks, but within as I said, different industry sectors in my stock portfolio, different types of maturities in my portfolio. I don't just buy bonds that have 3-year maturity. I have different maturities in there. I have different types of bonds in there. Municipal bonds or corporate bonds or treasury securities, asset-backed securities. There are all kinds of different bonds. And we're going to have a section on bonds. I don't know if it's the next one or one after, one of the next two. It's going to be on bonds. So we'll talk about bonds some more. We'll talk about, the crisis and all that happened. Everybody should watch the movie. The movie about the 2008 financial crisis.
The Big Short.
No.
Thank you, Big Short, Big Short. Thank you. Big Short. You're going to actually, kind of a homework for. I think it's in the next session after, homework for everybody to watch that movie. So because it explains all of this. Now, diversify the holdings within each asset category, not just across the assets. Across assets is important, but then within the asset category, you're going to have to diversify as well to get the full effect. Stick to your asset allocation model. Again, once you figured out that's the ideal model for you, you're going to stick to it. Unless your personal circumstances change. You have a long-term goal and now you realize, okay, my time to achieve the goal has cut short by 10 years for whatever reason. I'm going to have to make some changes. I'm going to have to adjust my plan for unforeseen circumstances. Rebalance. So if you say, okay, I want to have 80% stock, 20% bonds, and you have a change in your portfolio value, in other words, your portfolio value went up, and now you're looking at the total distribution. Okay, because of a huge increase in the value of my stocks, and not so much in my bonds. Now I'm owning 95% stock and only 5% bonds. So you want to sell some of these stocks and invest them in bonds so that you get your portfolio back to where you want it to be, that you have the asset allocation where you want it to be. Because it is going to change. It is not written in stone because the value of your assets is going to change. So the total amount of assets invested relative to the total portfolio value is going to change month by month by month. So you want to have some sort of rebalancing point. It doesn't have to be 2%, it can be 5%, whatever you want to do. But so you get back to where you were, because otherwise your asset allocation is going to be out of whack over time. Because some assets are just going to grow more in value than others, and you're going to be outside of your perfect asset allocation. Then you should never overload on sectors. 10 to 30%, and 30 is already high. And so in other words, again, you add your equities, and you say, okay, I have 80% equity, 20% bonds, that's my diversification. Well, then I buy some in the equity portfolio. Don't just buy everything in one sector. Don't even put like 50% or 60% of your money all in one sector. There is 10 sectors that the Standard & Poor's defines, the 10 sectors in the economy that you can buy stock in. Have stock in all 10 of them. Because now you are diversified across all the different sectors. Or if you just want to, just buy the index, just buy the stock market index as a whole, then you are diversified across all sectors because you just bought the stock market. You can do that. You can just buy the stock market. That way, with a mutual fund. You can buy an index fund. So a mutual fund is going to mimic the stock market. And you can just buy the stock market as a whole, and that means you're perfectly diversified in that stock market. Because now you hold a perfectly diversified portfolio. But you might not want to do that. Maybe you have some other ideas. Maybe because of your goals, because of your asset allocation goals, no, I want to take on a little bit more risk. So I want to perform better than the stock market as a whole. I want to take more risk, so I'm going to allocate more into one specific or two specific sectors and less in the others because I want to make more money. Again, it comes at the expense of more risk, more volatility, and the potential of losing money as well. Okay, any questions? Yes.
You talked about investing in currency, but I heard that Sweden is going to a moneyless society, and I was just wondering how that would influence currency.
Well, Sweden might go to a moneyless society, and I'm not quite sure how they're going to do that within the country of Sweden, but Sweden as an economy is still going to have money, or nobody's going to trade with them. People are still going to get paid. So, so there might be something within the payment systems of Sweden, which allows them, think about money. When we talk about money, it allows them the circulation of money. They might be able to lower the money supply. But, there's still going to be a value in that currency. And currencies are not going to go away. There's always going to be a value in currency. Because you're always going to have to exchange one currency for another if you trade with that country. So even if there's less of it, there's still a value to it. And again, currency is one asset class that you get into. Now, there's not a lot of movement in currency, so there's not a lot of money to be made, but it's certainly a diversification. Yes?
Usually you talk about negative interest rate. What happened when that happened?
Well, when you have a negative interest rate, then basically what happens is you borrow money and they give you money for the fact that you borrowed money from them.
Yeah, that's what you do. You put money, you're saving in the bill.
But yeah, again, you as an individual are never going to see that negative interest rate. That's never going to happen. Now, the Bank of Japan, but that's an interest rate that they charge banks, and the reason why they do that is because they want the banks to borrow money to actually put money in the economy. They're enticing them to get money from the Bank of Japan by actually rewarding them for more money. Now trust me, the people that then when the bank lends out money to the customers, they're still going to charge you interest on that because they have overhead to pay for and they want to make a profit on top of it.
No, I'm talking about saving. If I have a $10,000 in the savings,
Yes.
next year you got $9,900 left?
If you had a negative interest rate, yes. Then yes.
When that happens, what one person should do?
Well, then you don't save. You know, I mean, it's as simple as that. You don't. There's nothing else. You just keep your money in your pocket because there's no incentive for you to invest.
Do I have cash
You know,
with
is
me?
it, yes, or borrow it in the backyard. But trust me, it is not going to happen. I guarantee you that you're not going to see negative interest rates. Yes.
I didn't know if anyone had their hand on it.
No.
On slide 9, importance of asset allocation. It has a whole point of asset allocation is the most important decision, different asset classes, and I'll put down here, what if one company merges 2 or more asset classes? Does one invest in the company or the class?
Well, I mean, the 2 assets would be either like stock or bonds, and it's a matter of, you know, what asset you want to invest in, because they are very different attributes. You know, now, you know, if a company has stock A, class A and class B stock, it's still the same asset class. It's still stock. You know, now if you know, every company, if, you know, Procter & Gamble has debt outstanding and they have stock outstanding. If you invest in the bonds and the stock, depends on, do you want to invest in bonds or do you want to invest in stocks? You know, so the asset, there are 2 different asset classes. So again, the first decision that you make is what asset class do you want to be in, and then you decide what companies, securities do I actually buy, or whatever securities do I buy within that asset class. But the first thing is I figure out what asset class I want to be in. So I might end up buying Procter & Gamble stock and Procter & Gamble bonds. And I might find out that's what I want. But if I'm thinking about, you know, investing in bonds, I'm not going to look at Procter & Gamble stock, even though they have stock and bonds outstanding. No, it doesn't matter to me. I'm only interested in the asset class bonds. So I'm going to look for those. Yes?
I did not know they would offer both stocks and bonds.
Oh yeah, they need to borrow money too. You know, I mean that's.
So they would offer a bond because it's over a longer period or, you know, 3 years.
Well, yeah, because they want to borrow money rather than issuing equity. You know, so borrowing is actually cheaper for them to issue equity because interest income is tax deductible. You know, it lowers your taxable income. So on that regard, as far as the cost is concerned, borrowing money is actually cheaper for companies than issuing stock. And every company does it, even if they don't need it. Apple borrowed money last year, and they borrowed a whole lot of money, and they got it really, really cheap. And you know, and that's why they did it. No other reason. They don't need it. They have so much cash, they didn't know what to do with it. But they could get it really cheap and lower their, and then they move it, you know, they move the cash abroad so they don't pay taxes on it. And you know, they find a way. There's a reason why they do it. You know, and generally it's beneficial actually up to a certain point for companies to borrow money. And that's why they do it. But yeah, every company borrows money, and when they do, they generally do it not from a bank, but in the financial markets, and they do it through bonds. Yes?
So when one is investing, are you necessarily need to know more on the tax advantages and so forth?
Well, you know, if you invest in a bond, you need to know how that impacts you. That's an interest instrument. You earn interest income, which is taxed at your personal tax rate, whereas dividend income is not taxed at your personal income tax rate. So there are implications on that. Yes. Bonds are much more difficult to get. So as an individual, you pretty much have to go into bond mutual funds in order to buy bonds. It's very difficult to buy an individual bond. It's not a very transparent market. It's as an individual very difficult to get in there. But that's why we have bond mutual funds and they do just as well. And so that's the alternative for the individual investor to invest in bonds, other than treasuries, which you can easily buy. But all the other bonds, you should be going to the bond mutual fund to to get funds rather than the individual fund. It'll be very difficult to get. And you pay a premium if you do. It's not worth it. Yes?
Have any favorite rebalancing mechanisms popped up?
The rebalancing is a matter of taste, if you will. You know, how much of, if you're looking at mutual funds, you know, they have ranges, and they're generally 10% ranges. You know, so they have to be between 5 and 15% or something like that. And that's about what you see, like, you know. So if you want to be, you know, invested in stocks between 75 and 85%, then if you drop below 75 and go above 85, you're going to rebalance. You know, you just have to set your own goals. But if you're looking at mutual funds, they're generally in that 10% range, you know, up and down. And in terms of how much do you want at every stage in life, there used to be some you know, crazy, like 100 minus your age tells you what percentage of your money should be in stock and that kind of stuff. But you know, that's obviously, this is all, you know, tales of crypt that you really don't want to worry about. You know, it's more like the more you want to, the more you have to rely on fixed income, or the more you have to rely on the income generated by your portfolio, the less risk you want to take. It's as simple as that. And then it just comes down, how much risk are you willing to take? And one of the things that you can do is, you know, that gets very technical here, calculate something called value at risk. How much money do I lose? If everything in my portfolio goes down by 10%, if I see a market crash, and you know, market loses 10%, 15%, how much money am I going to lose? Just do a calculation. How much money would I lose if all my positions, particularly the ones that can change, my equity positions, lose 15% or 20%? How much money do I lose, and can I afford to do that? And because if I can't, then I better move something and something less risky. You know, it's a basic, and a lot of portfolios, they look at value at risk. How much money do my investors lose? Not so much of, again, nobody calls you when they make money, but they're all worried when they lose. And the value at risk, the downside risk, is what you want to focus on. How much can I afford to lose? So just do some scenario analysis, if you will. Just look at all your holdings. Okay, all my stock goes down by 20%. How much is that going to cost me? How is that going to affect my portfolio value? How is that going to affect my ability to draw income from that portfolio? And if it does, you probably want to shift. Or you want to think about what's the likelihood of that to happen. You know, go back and how often do we see that? How long does it take for these things to recover? Do I have the time or stomach to do that? You know, and that's all very individual. You know, there's not one blanket number that says this is what you should do. Some people are very, very okay with taking risks, and others not at all. You know, I want to make sure that I exactly get the same amount every month, and I don't care what I have to do to make that happen. I don't want to have any risk whatsoever. That is a very personal decision, and it has obviously to do with where you are in life and what your objectives are with that portfolio. Yes.
Do you think target date funds are practical possible success?
Yes, I do. I think particularly for somebody who doesn't want to worry about rebalancing portfolios, they're just, for those of you who don't know what those are, target date funds are, they're targeting basically your retirement date. You know, so they said you can buy this 2040 fund, for example, meaning they invest based on the fact that you will be retiring in 2040, and their rebalance their portfolio towards that over time, so you don't have to. You know, they're actually not a bad thing. You know, they're really good for retirement portfolios, particularly if you don't know, if you're not really good at this, you don't want to spend the time. You can always look at at their performance, and it's obviously hard to say how they're done or how they will do. But what they do is they shift the asset allocation over time for you. You don't have to rebalance. You don't have to change your asset allocation every so many years because they will do for you. You just give them the money.
Is that a mutual fund?
Yes. You can get those. Yes, you can buy those. You have a target date, and yes, okay. At this point, this is when you would want, when you draw income from them, and retirement plans for them. That say, you can invest in the 2040 fund, And they do it based on fact, okay, we want to have that money available in 2040, and over time, they're going to shift allocation to lower the risk and make sure that you don't have value and risk by the time you actually want to draw from the portfolio. Any other questions?
The next session in March, is it the 17th of March?
Yes, I believe so, yes. Any other questions? All right, well, thank you very much. Thank you for coming.